Alright, I'm going to walk through a couple of problems here from the accounts receivable chapter. First question here, Levin Company uses the perpetual inventory system and allows customers to use 2 credit cards in charging purchases. With the SunTrust Bank card, which is one of them, Levin receives an immediate credit to its account when it deposits sales receipts. SunTrust assesses a 4% service charge for credit card sales, which we would also recognize immediately. Second credit card that Levin accepts is the Continental card. For this one, Levin sends its accumulated receipts to Continental on a weekly basis and is paid by Continental about a week later, so it's not immediate. Continental also assesses a service charge, but this one is 2.5% instead of 4%. So what are we going to do here? First of all, we're going to record these transactions. So on April 8th, we sold merchandise for $8,400 that costs $6,000 to us. We sold that by accepting the customer's SunTrust Bank card. SunTrust receipts are immediately deposited in Levin's bank account. So what does that mean? That means that of these two, we're looking at this rate of 4%. So we're not going to get all of this money. We're going to get 8,400 times 96%. The other 4%, SunTrust is just going to keep as a service charge. So they earn that immediately when the card is used. So our recording of that 4% will immediately be in an expense account because we are immediately recognizing that as an expense. So we will record the fact that we had $8,400 worth of sales first. That will be a credit. And then to get to $8,400, we will have the 4% fee plus the other 96% that we get in cash, and that will make up the first part of our journal entry here. Now the other part of this journal entry, if you'll remember, this part here is basically showing from the customer perspective how much we're getting from the customer. And we also need to show from an internal perspective how this journal entry affects our company. So inventory needs to go down and cost of goods sold needs to go up. And it's telling us already what the amount is. That's $6,000, which is right here. So the second half of this is going to be cost of goods sold, a debit to that, which causes it to go up for $6,000. And a credit to merchandise inventory also for $6,000. If you'll recall, we kind of accumulate costs for the merchandise that we have within this inventory account, and we don't recognize them as expenses until the moment they're sold. And when they're sold, everything that was stored in there related to these items that we sold becomes an expense, cost of goods sold, which is what's going on down here. So obviously the difference between this and this would basically be more or less considered our profit for this transaction. Okay, so that's April 8th. April 12th, sold merchandise for $5,600 that cost $3,500 to us. Excuse me. This time we're using the other credit card. So now instead of getting the money immediately, this is going to be more of an accounts receivable situation. So again, we'll have less than the 100% up here. Well, the sales will be for the full amount, $5,600. And then we will have 97.5% in accounts receivable and 2.5% in fees this time. Yeah, so that becomes an account receivable because they're not immediately paying us. And then the other side of that, the internal side that shows everything that was stored in merchandise inventory, all of those costs becoming cost of goods sold, which is an expense account, which means this is the moment that those costs are showing up as costs on the financial statements. And then for April 20th, we received the account receivable payment for this amount here, which would then just be for the 97.5% that was owed to us. And that's that one. For this one, excuse me. Question says at year end, December 31st, Chan Company estimates its bad debts as 0.5% of its annual credit sales of $975,000. Chan records its bad debts expense for that estimate. On the following February 1st, Chan decides that $580, a $580 account of P Park is uncollectible, and at that point it's written off as bad debt. Then on June 5th, unexpectedly out of nowhere, Park comes around and decides to pay off the debt. So we need to prepare those journal entries. So the one that happens as of December 31st, remember this is an entry that we're doing as a nod essentially to the matching principle, where we're saying, hey, we've made all of these credit sales for the year, right? We made $975,000 worth of credit sales, and we recognize based on previous history or company or industry standard or whatever that 0.5% of our credit sales will be uncollectible and will become bad debts. So this is not us saying that these are actually bad debts. This is just us estimating, because since this money is an account receivable right now, and we really won't know who's going to pay until they either pay or they don't pay. We've got to have some way of guesstimating who's going to not pay or how many people are going to not pay, so that we can record the amount of non-payment in the period when those initial sales were made. So that's essentially what we're doing with this 0.5% times 975,000. That will give us our first journal entry down here. And this minus 0 here is just us saying that we had a 0 balance in the allowance for, or in the bad debt expense account before. So $4,875 would be 0.5% of 975,000. Previously we had 0 in there, so the full amount will be part of bad debt expense. And we have the corresponding credit going to allowance for doubtful accounts. So that then when time goes by, as accounts were written off, like we're about to do right here, that those write-offs will come out of this allowance for doubtful accounts. And you'll notice that when we're doing that, there's no expense account showing up when we're writing off a bad debt, because we already estimated a certain amount of bad debt corresponding to these sales. Now, if we went above and beyond what we already have in the allowance for doubtful accounts, then we would later need to make adjustments to ensure that we have recognized enough bad debt expense for the period. As of now, what we're doing here is just saying, okay, we're going to reduce account receivable by that amount, because we're saying we're not going to be able to collect that anymore, so it doesn't make sense to keep that on our books. And this 580 will reduce the allowance for doubtful accounts, because obviously if we set aside this money to pay for, or to this value to go towards doubtful accounts, it makes sense that as those doubtful accounts occur, we will chisel away at that money that we've set aside for that. Then if something happens and this person decides to pay, we basically are just going to reverse this initial entry here where we wrote that account off. So we're basically putting it back on the books with that, and then once it's back on the books, we would just treat it as if it had never gone away in the first place, and you see just what the entry would be down here. All right, next question. At each calendar year end, Macy's Supply Company uses the percent of accounts receivable method to estimate bad debts. On December 31st, 2015, it has outstanding accounts receivable of $55,000, and it estimates that 2% will be uncollectible. Prepare the adjusting entry to record bad debts expense for year 2015, assuming that the allowance for doubtful accounts has a $415 credit balance before this adjustment is made. Okay, so what is this telling me? For the year, we have this outstanding accounts receivable, $55,000, and again, based on industry standards, our history or whatever, we've determined that 2%, that our estimate is that 2% of that will be uncollectible. What that means is there needs to be within our allowance for doubtful accounts, as of the end of this year, 2% times this amount needs to be in our allowance for doubtful accounts. That doesn't mean we have to put that much in right now. It just means if we had a zero balance originally, then we would need to put in 2% of $55,000. Since we already have this $415 in there, what that means is we have $415 we've set aside as an allowance for bad debt already that didn't get used up to this point. So instead of needing the full 2% of $55,000, we would take 2% of $55,000 and subtract $415 from that to arrive at the amount that we need to recognize here. So what that means, this is showing you that the balance at the end of the day on this allowance for doubtful accounts needs to be 2% of $55,000 or $1,100. But before we make the adjustment, we have $415 in there already, so all we need to put in there is the difference between those two, which is $685. So that's what we'll recognize as new bad debt expense and allowance for doubtful accounts. And that's all I have for you today.